Hello, and welcome to the 2022 review and 2023 outlook. For those of you that might not know me, I am Diskin Young, and today we're basically going to try to look back and see what happened in 2022. The real estate market was crazy and has been for the last few years. So we're going to kind of dive into what led us even to that point. And then we're going to look forward to 2023 and try to do some forecasting and what we can look at in 2023 that might help some people make some informed decisions, what we might think as economists as well, what the market's going to do, etc. So let's get into this. And first, what we're going to be covering, kind of like what I just talked about, historic year for interest rates. Interest rates were just crazy this last year. We had record breaking appreciation in the last couple of years. We had forecasting that we're going to be doing for 2023, what caused the rise and fall of prices. Some people have been seeing a lot more price drops than we have here. For those that might not be in the area, I live in Bellingham, Washington, which is in Whatcom County. We're going to talk about, is there recessions going to be coming in 2023? A lot of people have been predicting that for the last few years, so we're going to kind of go over that, what we might see happen in 2023. For a soft landing and changes that would need to be made for a soft landing. The Feds use that term quite often. So, what is a soft landing and how can we possibly get there? The affordability problems that we are having right now, and then more inventory coming. What does that mean for the market? And is that a good thing or a bad thing overall for the market? So, first, let's talk about the perfect storm. I think this is the only way you can really start kind of putting this puzzle piece and picture together. Interest rates hit an all time low. As you know, if you bought a house or refinanced in 2020, late 2020, right around, or 2021, right around there, interest rates were at an all time low and actually stayed there till the beginning of 2022. So we saw an all time low in interest rates. Some people in the twos, mid twos, low threes, very low interest rates, especially historically. People were stuck in their homes and they needed more space, plain and simple as that. With COVID, forced everyone to stay in their homes. People that were all of a sudden working from home, as we see there, people turning to remote work. That caused a lot of different changes in people's lifestyles, and they needed bigger homes and they needed more space, so they could not be so cramped into small spaces. People are working from home. Um, One big thing here is 72 million millennials are reaching the home buying age, possibly the largest generation group in the US. In 2021, it was the largest group. And that played a huge factor. There's so much more demand for homes right now because we have all these millennials reaching their prime home buying years and trying to get into the market all at once. And that just caused the demand and supply chain to just go crazy. And then people had a large amount of disposable income overall when you compare that to past years. So that kind of led to the perfect storm that we saw so far. Let's look at interest rates. I think this has been probably the most interesting topic that we've covered in the last few years. It's been just a wild ride, I would say, for interest rates overall. So interest rates to start the year of 2022, we're at right around a national average of 3.4% to start the year. Incredibly low still, great market. If you were buying in, I would say January through about April, you were still seeing, lots of bidding wars. People were still in those low interest rates. The market was still humming. And then hit a high in October of 7.24%. So we saw, let's just say, a 4% rise in interest rates. We haven't seen that big of a rise that quickly in a long, long time, if ever. You can maybe look back to the 40s and 50s and see a slight raise like that, but it's a little bit relative in that sense. This way, a percentage growth we have not seen. So it was just a complete low to a complete high. It was crazy. We actually haven't seen 7% interest rates since December of 2000. So it's been 22 years since we've seen that high of interest rates. And that just kind of led to a large payment difference. You see here, I put up here, we ended the year at around 6.4 on a national average for what interest rates are at. That's kind of what we ended the year with. So they went to about 7.24, and then they came down slightly and settled in right around 6.4%. But the payment difference here, I think, is the big story. Let's just take 3%, kind of one of the lowest points we had in around 2021, I would say, is around 3%. If you bought a $650,000 house, or let's just say you had a $650,000 mortgage, which is right around the median price here in Bellingham. So I'm using that as an example. If you had a $650,000 mortgage at 3%, your payment, just principal and interest, was right around 2740 a month. 2740. Now you look at where we were at the end of 2022, right around 7% for that exact same house. Your principal and interest payment alone, that doesn't include taxes, insurance, all the utilities, nothing else, just principal and interest, you're looking at 4324 a month. Humongous increase, just a gigantic increase. So affordability, that's going to be kind of a theme that we're going to be talking about throughout this presentation a little bit more. That's a big theme that you'll see throughout this. So a massive gain in what your payment's going to be overall. Historic rise. I think we have to talk about this as well. We saw humongous rise over the last 3 years, and it's been unprecedented, basically. We saw a 32% increase nationwide for the median price we're talking here. So the median price in the US overall, we saw a 32% increase from 2019 to 2022. That is gigantic. So typically, in even a good market, I would say we see about 8% raise a year, right around there. I know a lot of economics people and historians like to use about 4% a year. So a lot of people say, oh, your house will appreciate by around 4% a year. We saw 32% in 3 years. That's unprecedented. Such a large appreciation gain has not been seen since the late 40s. That was right at the end of World War II. A lot of people coming back. That's the last time we saw this large of an increase in prices. And so we saw basically what would be considered a full decade's worth of appreciation in 18 to 24 months. So right around 2020 all the way to 2022, that kind of time frame, we saw pretty much that entire 32% in that time frame, which would be considered a good return or appreciation percentage for an entire 10 years that we saw in 18 to 24 months. So unprecedented historical rise. That combined with, I think a huge part of that was the interest rates. The interest rates being that low made it much more affordable for people to be able to buy things. And all this demand coming into the market, we just saw these prices go crazy. The fall. So we started to see this year. Slowly but surely, interest rates started going up. Why? No more quantitative easing. Quantitative easing is done by the government to basically make rates fall superficially. So they saw the issues that were happening in with COVID and everything. They wanted to bring the rates down because they saw the issues in housing and just borrowing money in general. They wanted to kickstart the economy. They did not want to go into a slump during that time. So for a good portion of the time, they kept the rates artificially low at a basically 0% federal fund rate. We haven't seen that low of a federal fund rate in a long time. So that basically brought all these interest rates far down. Once that stopped and we started seeing inflation, you see next there is inflation boost up. That brought all these interest rates to go along with it and started going up as well. Affordability is the real issue here. And the next thing I put there was rates are relative based on change. So what I mean by that is when you go from, let's say, 5% interest rate, which is pretty normal for a long time, 5.5% interest rate was pretty normal for a long time, and all of a sudden they go down to 2.5%, 3% maybe. Everyone's like, wow, this is amazing. I'm going to refi, I'm going to go buy a house, everything's so cheap. But on the flip side of that, when you go from 3%, which we were at for quite a couple years, I would say, if we go from 3% to 5.5%, 6%, which if it just went from 5 to 6%, not as big of a deal. But when it goes from 3 to 6% or 3 to 7%, that big increase makes everyone nervous, and they see it and they say the relative change in that scares me. So that had a huge impact on the market as well. People are getting so used to those rates being so low, and then the rates shot up like that. Everyone got afraid, and then inflation started, and it was kind of just a perfect storm for a fall, actually. The spreads of the interest rates and the 10-year treasury is really interesting to look at. Typically, we see that whatever the 10-year treasury rate's at, we see about 175 to 200 basis points on top of that is where the mortgage rates are going to be. Um, BPS is just basis points, basically, so you guys just know that. Um, what we are seeing now, though, is right around 325 basis points extra on top of that 10-year treasury. That is kind of coming from a few different things. Buyers of mortgage-backed securities, which is what kind of pushes this, they are seeing how the interest rates are really high, and they know there's no prepayment penalty on interest or on mortgages. So when they are looking at trying to buy some of these mortgage-backed securities, and they know, well, once the rates fall again, which we think they might, everyone's just going to refinance and then those go away. So buyers of mortgage-backed security need a bigger spread. Otherwise, they would just go buy a 10-year treasury, make basically the same amount of money, safer and more secure. So for them to buy mortgage-backed securities, they had to make sure that they boost this spread, so they will buy these mortgage-backed securities. And another part of this I think is happening is mortgage brokers or banks are saying, well, we have to increase the spread on money that we lend out because most likely it's only going to be for a few years anyway, because we expect these rates to go back down. They're not going to be at 8, 7, and 8% forever. So we expect these to be shorter term and people are going to refinance. So that's, I think, another situation from that is they wanted to make more money up front. Looking into 2023, so there's always a ton of what ifs when forecasting, and I don't think there's ever going to be anyone that can perfectly do that. I try to tell my clients this all the time is don't try to forecast or time the market. Time in the market's always more important than timing the market. Um, Too many people fail. Pretty much everyone fails at trying to time the market, and it's just overall not a smart thing to do. So when looking at 2023, I kind of wanted to put it in three different categories. I wanted to put it in what if there was a recession or a downturn in the market and values significantly dropped, what would need to happen for that to stay true for all of 2023? What if we're just on the same trajectory of like slightly down, not huge value drops, just slightly down, more correction ish in the market? And then what would need to happen for us to have a decently strong market again? So let's look at those three scenarios right now and kind of go through what would be needed on each one. So for a recession here, we would need the interest rates to probably go up again. So right now, as I speak here, rates are around 6.2. Um, for them to go to 7%, so go up significant, I think that would have a huge impact. Once again, that goes back to affordability. So if rates went up above 7%, we're going to have an affordability issue. Plus, not many people are going to want to be selling their house. I think that's another big part. Not too many people that have these rates locked in at 3.5, 4% are going to want to go sell their house and buy another house if the rates are at 7%. So that plays a big impact. Less things on the market. Values are going to drop because people are going to be a little bit more desperate for those that have to sell to try to get a buyer in there. If large inventory comes on the market, this is kind of counterintuitive, but the way we're seeing this, and we're going to talk about this again later, if a ton of inventory comes back on the market and the rates are still at 7%, there's not going to still be a ton of buyers on the market that want to get into a house payment like that. There's going to still be a lot of uncertainty in the market. So if a ton of inventory still comes on the market, they're probably going to have to drop their prices to get these people in there. and thus more value drops, especially with the comp value. If you see another house that just dropped their price by 20, 30 grand, you're going to probably have to do that if you have the exact same house relatively. And then inflation continued to rise, and the labor market does not go down. So if that happens, then we are still going to be having the Feds do rate hikes, which is going to lead to, once again, rate hikes in the mortgage-backed securities. Those are going to be going up as well. So let's look at the same trajectory. Kind of what I say this is just a slight decline in the market. We're not seeing huge rises or falls. Just kind of staying the same course that we're on right now, which is just longer days on market, slightly going down. So for that to happen, I would say rates need to stay above 5.5% for whatever reason. Um, we kind of look at 5.5% historically, and that's actually when the market typically switches. So if rates go below 5.5 or at 5.5, we typically see an uptick in activity for buyers and sellers. We're going to see more activity on the market. We're going to see more buyers jumping back in. So that 5.5% is kind of a sweet spot overall. So I'd say rates have to stay above 5.5% for us to stay on the same trajectory. CPI and inflation. CPI is the consumer price index. That's a big one for what things are costing out there, and that leads to what the inflation's looking like, and the Fed looks at all that very heavily. If those start to go downwards, that's going to be good. The Fed's going to ease up on their rate hikes, which they're already starting to do overall, and that's going to help us stay on pretty much the same trajectory. And I think that's going to be able to lead us to basically kind of a soft landing. I said stop rate hikes by the summer. Even if they did very few rate hikes throughout the year, I think we would stay on the same trajectory. I think if they stopped them, the earlier they stop them, basically, the better it will be for the housing market overall. So let's look at a strong market. What would be have to happen for a strong market to come into play? I would say rates around 5.5% or lower. I don't see them going too much lower than that, but I think if they went lower than that, we would see a huge uptick in demand very quickly. Again, this is kind of counterintuitive, but it goes hand in hand with the rates, more inventory. So if we had more inventory plus rate hikes or rates going lower, then we're going to see a much, much stronger market and overall much more demand for that product because there's more things to buy. Plus, the rates are lower, so it's going to lead buyers to wanting to get out there again. This is a big one, and this is very hard to do. But basically, headlines from major news outlets are going to have a better forecast. They typically are very doom and gloom, and if they see one bad year-over-year number or a slight downturn year over year, which we're going to see, especially by March, we're going to see those forecast or those year-over-year looks be negative. So I'm curious to see if the headlines are going to be, we're heading towards a recession, real estate markets are in the dumps. If we start seeing a ton of that, especially February, March, April time, this is probably not going to happen. We're not going to have a great market. But if they kind of switch that and say, we're seeing positive things out there, we're seeing upward trends, that's going to help consumer confidence a ton. And once we have consumer confidence back, that's going to be a very big boost in the market. And then just the obvious one of no more rate hikes and inflation going down. So if we see a Fed stopping the rate hikes pretty quickly this year, I think we have a chance to actually have a pretty good market overall. Let's look ahead a little bit and just some things I haven't touched on yet. CPI coming down and inflation coming down. That's already starting to happen. The big thing is right now is labor markets are still really, really strong. I kind of think right now that's the last thing the Feds are kind of looking at is they want to see those labor markets not as strong. They basically want to see those going away a little bit or going downwards a little bit. So that's kind of the last piece of the puzzle I think the Feds are looking at with these rate hikes is they're saying, oh, okay, CPI is coming down, inflation is coming down. Well, the labor market's still really strong. And that's the last kind of piece of the puzzle that they're looking to see a downward trend in. But I still think overall a soft landing is actually very possible, which if you asked me this question 6 months ago, I would probably not have said that. But I actually think it's more likely that that could be a possibility. We have to remember that we haven't dealt with true inflation in most of our lifetimes. The last time we've had that is probably 60 years ago, 60, 70 years ago. We haven't had true inflation in a very long time. So this is kind of all new for the Fed to kind of deal with. Um, Next on there is a very large amount of inventory is coming on, but not necessarily what we need. And the reason being, and kind of the thoughts around that, is there is a lot of new construction coming on the market. The issue with that is lately, as probably everybody knows, prices have been crazy. Builders had to pay those prices as well. We saw, 3 years ago, the lumber costs were crazy. What they're going to have to do is they have to charge a certain price for these homes that they are just finished building. And those typically are not going to be for first time home buyers. And again, once we go back, millennials are the first ones coming into the home buyers, and they're more the new home buyers. They're not probably going to be able to afford all these brand new prices in homes. So what we need to happen is we need people that have already bought their first home to sell that home and do a move up into these brand new homes. The issue with that is if they bought that house 4 years ago and they're sitting there nicely with a, you know, 4% interest rate, they aren't going to want to switch it for a 6.5% interest rate. Or even if they have a 3% interest rate, they're not going to want to trade that for a 6.5% interest rate. So that's going to play a huge factor in that. Um, the main thing with that is being it's not necessarily what we need. We need a lot more people selling their homes to move up to those new homes, and then the first time home buyers can buy those first homes that those people are selling. So we'll see if that happens. I'm not very confident in that, but we will see, and we'll have to keep track on that. The recession has been predicted for the last 4 years. One of the classic sayings, economists has called the last 8 out of 4 recessions. So they always are saying there's a recession coming. There's a recession coming. We haven't seen one yet. Technically, a recession is 2 down quarters in a row. So we have seen that, but true felt recession by the true consumers, the everyday consumers, we just haven't seen that. Labor market's still really good. Pretty much everything's doing well except for the stock market has gone down. But overall, we haven't seen a true recession yet. So we'll see if that happens. Everyone has been predicting that for a while, so this would be probably the year it might actually happen and come. We'll just have to see. We would need a 32%, I kind of touched on this earlier, a 32% decline nationwide to go back to the 2019 median price. That is not likely to happen. That would be a massive drop. Talking about in 2008 here, we saw a 2020 or 22% roughly drop in the median price in 2008. So a 32% would be just a historic downturn in the real estate market. So that would be very unlikely to happen. I don't see that coming into play whatsoever. Final thoughts for 2023. Like I've already talked about a little bit, there's a ton of new homes being built right now that have been basically about to come on the market for, I would say, the first quarter or second quarter of 2023. There's also a very large amount of multifamily coming onto the market. So this is via JP Morgan. This is actually the largest percentage increase in multifamily coming onto the market since 1970. So that includes rental properties and homes like condos, etc. So in the multifamily market, though, so that's going to be a humongous dump of supply into the market, which, especially if it's rentals, that will affect the home prices as well. But just want to let you know that is coming in the beginning of 2023. So the other thing is we're very, very bad at forecasting rates. Pretty much historically, no economist or anybody can truly do well in forecasting rates. And I heard an economist say the other day that he said, if you tell me what the mortgage rates are at the end of every quarter, I'll tell you exactly what happens to the real estate market. So he said, but nobody can do that. Nobody knows what's going to happen. That's why we're kind of looking at these little indicators that I've been talking throughout this video and just kind of trying to paint a picture for everyone of if this happens and if we start to see this throughout the year, this is most likely what's going to happen. But if we see this over here start to happen throughout the year, we know what's going to be happening in the market so then you can make a more informed decision. Again, I wouldn't be surprised if we see around a 10% decline in some markets. I think we just had so much appreciation and so much demand for such a long time that I would not be surprised if we start seeing that go down and do a soft correction in the first half of 2023. That just wouldn't surprise me at all. Of course, every market's different. Take Bellingham and Whatcom County, for example, where I live. We're a lot more isolated from this overall, but then you have places like Scottsdale. I know Boise for a long time. Those corrected very quickly, so they might see an actually a bigger than 10% decline overall. And then we should see a little bit of a stabilization in the market starting June or July. The reason I say that is when looking at everything that the Fed's saying, my guess is that they're going to stop their rate hikes right around there, and that, or possibly a little earlier actually. And then we're going to see rates start to go down. And once those rates start to trickle down, especially below that 6% range, into again the 5.5 range, I think that's when we're going to start seeing the market go from going down to just slightly stabilizing. That's kind of my prediction for this year is right around June, July, we're going to start seeing stabilization in the market. All right, that's kind of overall what I have. A lot of research went into this. I don't take this stuff lightly. I have pages and pages of notes to do a video like this. So I want to thank Altos Research. They were big. They have a ton of stuff, and they have a ton of podcasts and articles out there. Plain English is a great podcast as well, and they have quite a few on the mortgage market, and they have some really good people in there and economists on there that talk. And then I go to those economist pages and I read more about what they're thinking. And then I subscribe to Housing Wire. It's also a great resource that has just tons of economic research and articles on it. So these are kind of the three main places I use to gather data and everything for this presentation. And if you want to look into any of them yourself, I would highly suggest it. And just want to thank you guys for listening to this presentation. It's a little longer than things I normally do, but when trying to go over all of 2022 and beyond, and then go look into 2023, it takes a while to go through all that. If you have specific questions about the market, I love talking about this kind of stuff. And if you want to go through any of these numbers, feel free to get a hold of me. My email is diskinrealestate@gmail.com, or with a unique name like Diskin, you can just Google me and find me there. All right. Thank you, everyone.